Your financial story was clear, logical, and compelling. Now, here is Team 3 to present their findings.
Warm good afternoon to everyone present here and also the members online. So I share Verma and with my standing here before you to present one of our portfolio construction, that is Alpha V to our portfolio construction. Why we have chosen our team as an alpha, or let's just say the wolf approach, because when you see a wolf in the wild, then it does not survive by strength or alone. It survives by the strategy, discipline, or adaptability and awareness of the environment. Same just like when you work into the investment sector, when you work into the financial market, alpha represent a wolf of a hunting skills. So alpha, what we understand by our working, we found that it's not just about the predicting the market. It's about how we are choosing the alpha and how aggressively we are choosing it, which is defined by the beta. So with the next slides, I am give you a executive summary. Then we have taken a last 5-year study that is from 2020 to 2025, and most of our data are taken from the Provis database, where we have taken Nifty 500 and Nifty 50 as our benchmarks. And after cleaning those data, we got up to 327 securities with a consistent benchmark. And with that working, we made a methodology into 2 into 3 matrix and 1 into 3 matrix, and pure benchmarking on pure alpha and beta. 2 into 3 benchmarking is done on high alpha or high alpha and different beta. High alpha and moderate alpha with different level of betas, and 1 into 3 matrix is about the high alpha and different beta. With the further, I would like to call Faz, team member.
Good afternoon, everyone. This slide explains why traditional equity portfolio fails to deliver consistent value. First of all, problem one is beta-driven performance, which does not tell us separate skill from the market luck. Another was in short-term decision making, which tells return look good on paper, but net return suffers. Problem 3 is no risk return classification, which tells risk management becomes reactive instead of design. Problem 4 is limited investor customization. That means capital allocation is inefficient. So the core challenge is how do we construct equity portfolio that clearly separate alpha from beta, deliver consistent excess return, control risk, and reduce uncertainty churn. So our alpha beta matrix directly addresses this by classifying security first by alpha quality and then by beta risk, creating portfolio that are both performance driven and risk aligned. And further on will be discussed by the Anish.
So good afternoon, everyone. As it was mentioned that we have taken pure alpha, pure beta, 2 into 3 matrix, considering high alpha, moderate alpha with diversified beta, and high alpha and diversified beta for 1 into 3 matrix. So let me bring to your notice that the pure alpha that we have selected, we have done Vensurization. In that we have eliminated the outliers from the top and from the bottom, and based on that we have selected 20 securities for our analysis. So the process was data import and cleaning from Provis. Second was alpha and beta computation, in which alpha, which shows the excess high return, and beta, the market sensitivity, that how volatile is the market or how volatile is the security in comparison to the market. Alpha beta coding that we have given for our shortlisting. Then we have created a matrix based on that, the 2 into 3 matrix and 1 into 3 matrix. The portfolio construction, it consists of 10 to 20 securities based on our high alpha, moderate alpha, and other diversified betas. We have calculated the return, performance evaluation, and annual rebalancing. So this is one of the screenshots that we have put here for our 1 into 3 matrix, in which we have few stocks which we have given the label as high beta, moderate beta, low beta, and the alpha in this is the alpha that is high alpha. And the return from this portfolio is 41%. And in comparison to Nifty 50, it was for 24-25, it is 6%. The another one is 2 into 3 metrics, in which the same thing has been done, and still we are getting 41% as the return. So based on that, we have created a scenario that if an investor is having 1 crore rupees and want to invest in the market, so how he can invest, or how we can suggest him to invest in the market, or how we will be investing in on behalf of him. So the investment in equity, we have taken 5 scenarios, that is 85% of the amount, 80%, 75%, 70% and 50%, in which the rest amount will be invested in corporate bonds that will provide a fixed rate of return that won't be affected by the interest rate changing in the market, in the bond market. And then the interest that is coming will be on the monthly basis. That is our assumption. And it will provide 8.7% of return. And that this amount that is being coming from the bond market will be reinvested in mutual funds. So at the end of 1 year, if an investor is investing 85% of their investment amount in this equity and other components, then he will be having 1 crore 35,84,723 rupees. Compared to the 50%, he will be having 1 crore 24 lakhs 97,000. This weightage is being taken into consideration based on the risk aversion of the investors.
As you have seen the methodology section, that how we have worked on our portfolio constructions, let's just move into the transforming portfolio. How we can take out the words. So we can see that all the frameworks are done into structural level. It is in a systematic manner. As if I say systematic manner, it is rule-based, not discretionary. Stocks are shortlisted and clean in a skill-driven, not it's market-driven, because it's not just about how you predict the market. It's about how you analyze your market, what is good for you, and what are the securities that are available in the market in which you can safely invest. It also, while taking the weightage, we have done on the equal weightage. But if anyone wants to change the weightage as per the portfolio, he or she can directly change it from the structures, and according to it they can churn out the different portfolio section and construct it as per their basis. So it made on the multi-layer architecture and support multi-investor segments. Annual rebalancing is done with adaptability and cost efficiency, and you can see a transparent and auditable process for the governance. Governance, if I would say, yesterday we having an ESG topic. So, and if we talk about in ESG, then environmental consideration were addressed also here, because the preference of the companies was with stable operations and reckoning the alpha. It has avoided the highly volatile or speculative or governance risk heavy firms. We have focused on long-term business sustainability, reflecting the performance persistence. And the portfolio is quant-driven. It's implicitly favors company with operational discipline and often aligns with the environmental responsibility. Moving with the success metrics, we can talk about the consistent benchmarking and long-term portfolio performance. So that's all from our side. We would like to jury for any questions if they have.
Amit sir, please, for jury highlights.
No, thank you. What is the period you have taken for computation?
So the period that we have selected is March 2020 to March 2025, the year end.
Is that not the best period for the market?
So even if, yes, sir, I agree that you're talking about COVID, the 2021.
So you have taken the lowest point,
Yes, sir.
and you have taken the best point.
No, sir, even still, it was seemed to be a lowest point, but if you would allow me, I will show you one
Yeah,
Excel sheet. Share me. So the period that you're talking about, sir, the metrics that we have created, the securities which we have selected, is giving a return of 230%. It is slow, I think so, network issue.
That's okay.
It's giving a 230% return. That is literally abnormal. And if we talk about pure beta sorting, then it is giving 1800% return. So we cannot rely on that. So even if we skip this year and we take the period from 21 to 25, then our portfolio is beating the market.
No, it doesn't matter.
Yes,
I'm
sir.
not saying that. See, the period, the point here I'm trying to make is, I mean, we are taking the start point for your portfolio, let's say, model creation and all, is the most pessimistic scenario in the industry at that point in time, across the globe.
Yes.
And then 25, which is basically, I mean, everything was like behind us in terms of, the issues and all. So from the performance perspective, I mean, during this period, if we pick up any stock and all, they must have given 2-3 times returns and all. I mean,
Yes, sir.
So that is one, I guess. I mean, for your analysis, I think, I mean, you need to stretch the period, I guess. 5 year is too low a period for doing the model portfolio creation and all, to capture different cycles, Second, when you're saying that you have eliminated the outliers, on what basis have you eliminated the outliers? Is it only from the quant perspective, or is it some other analysis within the category of stocks also, been considered while selecting the outliers and all?
So the outliers that I have mentioned about, that we have removed the outliers using the venturization method, it is only for the pure high alpha.
Okay.
And for the rest of the portfolio, we haven't removed the outliers. We have considered them, and we have tested and seen that what are the returns based on that.
And can you go to your analysis sheet, I mean, which you are showing in terms of the allocation of funds, 100, 70, 80, 50?
So it is slow.
No, the slide.
Yes.
Yeah, so the point here is, what about the tax impact on the portfolio? Has that been considered or that not been considered? Because I read in one of your document you mentioned that in case of the investment into the bond securities, we have not considered the tax impact because the returns are less than 3 lakh rupees.
Yes, sir.
But what about the equity? It is now taxable after 1 year.
So it will be taxable if we are rebalancing, selling those stocks and then reinvesting. Then
But that you will be doing for the rebalancing purpose after 1 year, right?
So if we feel, then only. Because
will
there
be
are
there,
few. Yes, sir.
correct.
Because there are few
And
of.
because this is a non-discretionary portfolio,
Yes, sir.
there will be a tax implication on the investors. Unlike in the case of mutual fund, where when you churn your units, you don't churn the units, you churn the portfolio
Yes.
stocks. So for the unit holders, I mean, the tax implication is 0 because I'm not selling the units. But in case of the portfolio, I mean, the non-discretionary portfolio, you will be selling the stocks in my DP account. So there will be the tax implications.
Yes, sir.
So that, I don't think that you have considered. And second, what about the management fee? That has also not been considered, right?
No, sir.
So from the investor perspective, if I ask, your portfolio is going to deliver me what return? What will be your answer?
So if we consider all type of investment, then it will be around 35%.
But you don't know what is your management expense going to be for running the portfolio, right?
So basically, what charges they are having in the industry is 2 to 3%.
That's only the management fee that you are charging.
Yes, sir.
The expense ratio is different. So that I think you have not considered.
Yes, sir.
So to that extent, I mean, the returns are overstated,
Yes.
right? And what about, and the last point in your presentation, you also covered the governance aspect as well. So is it pure quant portfolio, or is it also, touching upon the governance aspect as well? Because all I can see, it's more from the quantitative perspective based on your beta, alpha, and all you have selected the stocks. But then how that takes care of the governance aspect of the stocks and all? What in case if there are companies sitting in that out of 327 stocks, where there are auditors qualifications, there are defaults, there are criminal charges, penal charges, so on and so forth. Have you considered those aspects to eliminate the outliers?
Beside, as in the start I've already mentioned that it is mostly on the quant, and in the governance sector, if we look into, then beside, you also mentioned about the tax and all. That is also one of the governance part. So that is something which me missed out. But if we get into the thoughts that you are saying, then if I am earning here around 26%, or let's just say the earning is total 1 lakh, 1 crore. So I would say with all the expenses, I could earn around, let's say 90 or 30, because moreover, the governance aspect doesn't give me that much of losses. If
Governance
I
can take away the stock completely unlisted as well, right?
Yes, sir.
So my entire investment can just wiped off.
Then I would say, sir.
So what in case if tomorrow, your portfolio, I as a portfolio manager, I invested your money into a stock. Tomorrow that stock just go unlisted, or barred from the security markets and all.
So even if that happens, then we are having a portfolio which consists of multiple stocks. If one
I'm an investor, so I'm concerned about my stock. I'm money and all, right? So that money is lost. That portion of money, let's say, I mean, if 2% of your, if I'm giving you 10 crore check, I mean, 2 lakh rupees you are investing, or 20 lakh rupees you are investing into that stock, that money is gone. So my portfolio automatically reduced by 2% and all, correct?
Yes, sir.
And last question here, I mean, in this calculation, when you are saying that the interest is reinvested into the mutual fund, it's a 1 year portfolio, correct?
Yes, sir.
So should we not consider the change in the price of the bond as well at the end of 1 year?
So
I think we are taking
corporate bond. We are taking
listed
yes,
bond,
sir.
right?
Yes, sir.
So the price will also have the impact
No, sir.
based on the interest rate movement, or let's say the deficit, other economic parameter movements, and also the bond price will also move, correct?
So bond price moves with the market condition, economic condition. I agree with that, but we are investing in a fixed rate bond.
Doesn't matter. Your fixed rate bond is not going to change. Your coupons are not going to change at all, but your bond price is going to change, correct? So at the price at which you are investing into the security today, at the end of 1 year, I mean, that security price will also undergo change because of, let's say, the expectation on the yield curve. So that will also have an impact on the portfolio returns.
So for that, we can have trajectory yield curve
So
for
we have
monitoring that.
So we have not
Yes, sir.
considered that as well, correct? So far.
Yes,
I mean,
we have considered, but not shown here because that working is in another laptop, and
no worries.
it
Don't
was.
worry. That's it. I think. I mean, that's all from my side. Thanks.
Thank you, sir.
Yes, Santosh, to the others.
Yes, Dinesh sir, please. The jury highlights from the Dinesh sir.
Yeah, thank you, Santoshji. So, team, I had one question in terms of the 2 into 3 alpha beta matrix and 1 into 3 high alpha matrix. So, which particular which particular tangent have you selected for this portfolio? Which one is giving you the highest return? So I didn't get that.
So-
Sorry if I missed that out.
So if we compare it year on year, they are the portfolio that is consisting of 1 into 3 metrics is giving less return. As you can see, it's 27%. And the portfolio with 2 into 3 metrics, it is giving 48% of return. So our suggestion is that the 2 into 3 matrix is consuming some of the risk in the market and is trying to provide the best possible return.
Okay. Is it because of the fact that in the 1 into 3 you have already considered all high alpha only,
Yes, sir.
and therefore once high alpha has already been triggered in the next year, it might not come into that category? Is that the reason? Also, one related question to this is like what would be the churn in the portfolio? So like, let's say, year on year, how many companies are going off from the portfolio and how many new companies are coming in?
So on an average, if the portfolio consists of 10 holdings, then 3 to 4 of the holdings, 4 to 5 of the holdings are common in all the years, and rest are changing.
Okay. And is there anything, any specific criteria or a trait which could characterize those holdings which are staying common across all the years? Like, did you find any specific trait, either quantitative or qualitative?
So the thing is that the stocks which are staying consistently performing, they are fundamentally strong, and they are sorry.
Secondly, I would say that investors has a trust on those portfolios and they invest a lot in that. So they have a consistent returning and their profit or adjusted in closing price, if you can see in their annual report, they have a regular return of more than 500. So these are the bonds are consistent. Like one of you here, you can see Adani Enterprises. It's of year 2023 and 2024. Similar, if here I could see it's KPIT technology and Patanjali. So these are the securities where in the investors having a trust and they doesn't think that these securities would fall. There was one of the security that investors, or let's just say HNIs, said that the security will not fall, and ultimately the technical analysis told that this will fall. So ultimately it was fall. This was something which was not expecting. I don't exactly remember that security, but that was something happened. Even though trust is having the person, but it depends sometimes how the information is moving into the market.
All right, got it. I think that's it from my side.
Thank you, sir.
Jury highlights. Yeah, now I'll request Samba sir to give the jury highlights.
Yeah. So all the three teams, I would say, have done. First of all, you should be proud that you have done a great job. So I think we should put a big round of applause for each of them. And yesterday I was also talking to Anish, and he was very happy to show me some of the Excel sheets which he's showing here. So I was partially I had a sneak preview of this project yesterday. Unfair advantage or disadvantage, I don't know. But overall, I'm not evaluating, right? So therefore it's okay. Right? So I'm not evaluating. So, but I think overall each of you have done a lot of hard work. In fact, I was talking to Professor Santosh Kumar asking how much time you have taken. So he said 6 months you have started working on. But I'm sure in the last couple of weeks you would have done maximum amount of work. 90% of the work is saying that it come in the last 1 week, which is fine. Like we are always in the Kanban kind of a thing, like just-in-time management. But overall, I would say that the efforts are really good. And in fact, the way you guys have articulated is also good. Some of you spoke very well. Some of you can improve your communication skills. So that is also one important thing, right? While you have done a good job, it's also important that there should be some kind of a storytelling ability to learn that skill. One skill which is important for every one of us, including myself. Everyone needs to learn how to tell stories. So if you put it in a certain way in which easy and simple to understand, then it becomes easier. For storytelling, you should first understand the audience. So what is the audience and what type of stories you need to tell them? It's always important. Once you understand, supposing you are a portfolio manager and you want to talk to a HNI. So you need to do a lot of research about that HNI to find out what is it that tickles the person. So that way, then what happens is that you can get more influential. With that, I'll close. Thank you. Yeah.
Thank you, sir.
Yeah, thank you so much, sir. Now I request the grand jury team to proceed for the further activities.
Thank you, team 3. Request our respected jury members to share their highlights, observations, and the feedback on the presentation.
Jury highlights almost intermittently they have done. It's a completed. So you may
sir.
proceed.
So
Yeah.
now I would like to request Professor Ranjit Tiwari, sir, convener IFMC 2026, to deliver vote of thanks.
Yeah, some small mementos we had.
Before the vote of thanks, sir.
Yeah.
Sir, please, Ranjit, sir. 1 minute. Before the vote of thanks, I would like to call Santosh, sir, for the memento distribution.
Yeah, Ranjit, sir.
Please, sir.
Dr. Santosh Kumar, sir, to present memento to Mr. Sambisan Ji, Chief Finance Officer, Tata Play. I also request Dr. Ranjit Tiwari, sir, to join.
I would request Dr. Santosh Kumar, sir, and Professor Dr. Ranjit Tiwari, sir, to present memento to Amit, sir, CFO, International Business, fintech.
Thank you, sir. Now to formally conclude the Factor Ju contest, we invite Professor Ranjit Tiwari, sir, convener IFMC 2026, to deliver vote of thanks. Over to you, sir.
IFMC Patron, Director CIMP Dr. Rana Singh, Chief Administrative Officer, Mr. Kumud Kumarji, Keynote Speaker Academia, Professor Chandan Sharma, I am Lucknow. Keynote Speaker and Jury Industry, Mr. Samba Shivanji, CFO Tata Play, Mr. Kumar Ayashkanta, Treasurer ENY GDS, Mr. Amit Murarka, CFO International Business KFin Technologies, Mr. Rakesh Arakeri, CFO Takutik, Mr. Dinesh Abu, ex-CEO Finmeric, Mr. Deepak Mandal, Director Thomson and Reuters, he will join us in the valedictory as well. MS Sandhya J, Group CFO, Narayana Health CFO Masterclass, Mr. Assis Khatua, Associate VP JSW Steel Limited, Track Chair and Jury, Professor Vipul Singh from Shivnadar University. Good afternoon, everyone. At this juncture, it's my pleasure to propose the vote of thanks on behalf of me as well as on behalf of Chandragupt Institute of Management, Patna. I express my gratitude and heartfelt thanks to IFMC Patron, Director CIMP Dr. Rana Singh, for his continuous support and mentoring for smooth conduct of the 4th IFMC 2026. I, on behalf of the entire CIMP fraternity, express my gratitude and hearty thanks to Keynote Speaker Academia, Keynote Speaker from Industry, External Jury, and Grand Finale Factor Ju participants for gracing the inaugural ceremony and sharing valuable experience. Thank you all very much. Have a nice day. And post-lunch, we'll be starting our technical sessions. So be with us for the technical chairs. We'll have 7 technical sessions. So thank you very much.
Again, I will request both the jury members to come on the dais for the group photograph. Tree will be served in the CIMP auditorium lobby. We request all the conference delegates kindly return on the time for the next session.
Dr. Barun Thakur.
Good afternoon.
I'm Dr. Sunil Kumar, professor at CIMP Patna.
Hi, sir.
Hello. So we will be chairing this session, and total 4 papers were there, out of which there's 1 absentee. So we have 3 papers. So I hope that the paper presenters have joined. Can you confirm? So Dr. Barun, shall we start, or you want to say something?
Yes, sir. Yes, sir. Yes, sir.
Okay. So first presentation will be done by Dr. Ankit Khare and Ms. Nisha Siddha. Are you there, Dr. Ankit?
Yes, sir, I am here. I'm in the meeting. Am I audible to everyone?
Yes, you are
Yes.
audible.
Good afternoon to the respected chairpersons of the session and to the
So,
participants.
Dr. Ankit, please complete your presentation in 10 minutes so that we have some
Sure,
time for questions and answers.
sure. The topic which I am going to present today, the paper
Sir,
along
please,
with my
for a minute, sir, your screen is going to present. Sir, please wait for a minute.
sure.
Now you can present. It's okay. Your PPT is visible now.
Okay. So the topic of the presentation and the paper which we have made is the psychology of online investing. It is the influence of social media on investor decisions in the Indian stock market. I am Dr. Ankit Khare, Assistant Professor, Department of Management Studies, Baderia Global Institute of Engineering and Management. Along with my colleague, Ms. Nisha Shidra, due to some medical emergency, she is unable to join us today for the presentation. We both give our regards to the chairperson and all the participants of the session. The topic which we have covered is basically about the influence of social media on the uh, yeah. So as we all know, social media and Indian stock market, they both are on the rise. Indian stock market experienced significant growth in recent years, emerging as a key player not only in local but as a global financial landscape. For the past decade, we have witnessed unprecedented expansion in equity participation, and the data of Indian Stock Exchange basically shows us that the number of individual investors have increased multiple folds. New retail investors are entering the market within a very short period, and this surge is post COVID period. This number has increased manifold, and there are many reasons which are related to that. That is, the low cost online brokerages have come up. And there are convenient apps through which we can make our investment, and UPI based payment system and all. They have made investment very convenient for today's generation, which was not earlier available. But on the same side, because of this huge investor base, there is another thing which has come up, like people are not relying on traditional methods or traditional sources of information only. Rather, now the dependency on information has increased into the social media platforms like YouTube, Telegram groups, Twitter, Instagram, where we have so-called financial influencers, who are giving various tips to the investors where they can invest their money. So this is an area which we are trying to cover in our study. If we talk about a little bit of the literature which we've come across during the type of our study, we have seen that in traditional financial theories, efficient market hypothesis, which was given in 1970, it assumed that investors act rationally based on available information. However, behavioral finance challenges this notion by emphasizing that investment decisions are often driven by cognitive biases, emotions, and external influence, which was proved in paper given by Thaler, Kahneman, and Levitsky in 1979. Social media further amplifies these biases, particularly herding behavior, where investors follow trending stock discussion without independent analysis, and also overconfidence bias, where individuals overestimate the ability to interpret financial data. Also, it has been seen there is a term which is called as FOMO, that is the fear of missing out. Many a times, when investors come across various financial information, they tend to have a fear that they might be missing on to something where they are not able to get proper investment or they are unable to make investment. So these are some of the things which we have come across in our literature review. Okay. So we have certain objectives of our paper. These were the main objectives which we have covered for our paper. That is, first of all, we want to examine the extent of reliance on social media for stock related information and investment decision among the investors. At the same time, we want to identify what are the most influential social media platforms which are shaping up investor perception and attitudes. What is the role played by financial influencer or influencer, as the terms goes, on online investment communities for trading behavior and behavioral biases? Then impact of social media on the stock market recommendations and investor perception on the investment outcome. And lastly, we have also tried to inculcate what is the investors' awareness level about misinformation, unverified advices, and regulatory intervention related to these kind of things. This is what we are trying to discuss in this paper. We had the hypothesis in the paper which we have created, that is social media usage has a significant influence on investment decision among individual investors in the Indian stock market. The second hypothesis, investors who rely more heavily on social media for stock related information and recommendation exhibit higher level of risk taking behavior in the investment. And the third hypothesis is investor level of stock market experience is significantly related to the reliance on social media for investment decisions. So these are some of the areas which we have covered. In order to understand the research gap, we have come across that not many studies have been done in the context of Indian stock market, where the relationship between the social media influence and investor preferences has been studied. There are certain literatures available from the Western side, but there was not much literature available in the Indian context. At the same time, in our research, we have to follow a research design which is based on a quantitative research design which integrates both primary and secondary data to encapsulate the behavioral pattern of retail investors. We have conducted an online survey where we have collected data from the people who are retail investors or who are likely to invest in the share market based on the social media and information which they get. We have also tried to cover information from academic journal and industry reports like SEBI and all. The key area was social media and investing, herd behavior and biases, misinformation and emotional drivers. These are the areas where we have tried to collect the data. Also, we have also tried to analyze the sentimental analysis and purposive sampling, because the method which we have adopted, because of certain limitations, we have to go for the purposive sampling technique, because we were only focusing on people who are retail investors or who are likely to collect or likely to invest in retail market, share market based on the social media influences. Okay, so the key findings which were there from our study, I'll just share very quickly because of the paucity of time. Out of the valid responses from 71 participants which we have drawn, we have seen majority of the respondents were in the age group of 36 to 45. That is a age group which is more likely to invest in social media because of the future needs which they are going to come across. At the same time, they are in the area where they have a disposable income, where they are looking for avenues where they can invest their money. And most of them were salaried employees, which are mid-career dominated people. And were also people who had moderate level of stock market experience between 1 to 5 years. The monthly investment average was largely to be below rupees 10,000. This was the basic detail of the sample which we have taken. Then social media usage, when we ask questions about social media usage, most of the investors, almost 50% were said that they are encountering these kind of content daily on their social media platform which they use, like Facebook, Instagram, Twitter. And they said that most of the information which they get are from market forums, which is made by different channels. YouTube and Instagram is mostly used for accessing this kind of information, and mostly they follow the market news as a main content. Okay, then when we asked about perceived influence on social media, so 63% said that social media have an effect on the investment decisions, but at the same time they said they agree that it increases the stock market volatility in India. Because when there is, like a few days ago, we saw when the budget came in on 1st of February 2020, there was a lot of volatility in the market. And because of certain promotion things which came across in the social media, there was a steep fall in the market. I would like to say social media might not be the one reason for that fall. There were many issues in the budget which made the market to fall. But this panic which is created on social media also play an important role in that. At the same time, when we talked about decision-making behavior, most people say they do not solely invest on social media tips, but the higher exposure to this social media tips which they get on different platforms has a likelihood where they might act on this kind of information. So the likelihood of acting on this information increases with continuous exposure to the social media. At the same time, 38% of the people follow the financial influencers, and they say that influencers following an investment experience are significantly linked to the social media based behavioral bias, where when they follow certain people, they create a certain kind of image in their mind, and they tend to follow the tips given by those investors. There are many financial influencers like who create this content and who have a very huge following on social media, and they have an influence on the people. I will not name these kind of influencer here, but we all are aware about that. Then, when we talked about risk awareness and regulation, many investors say that they verify the information before acting on that, and some of them, around 28.2%, have sometimes suffered a negative outcome. That is because of certain social media tips, or when they have made investment based on that, they have to suffer certain kind of losses. So it was one thing which came across in our study. Then, when we talked about the hypothesis testing, statistical evidence, we came across that there is a moderate to positive link between social media exposure and investment decisions. Then, influencers following investors are more likely to act on the recommendations by the social media influencers. And it was also came across our study that 1 to 5 years experience, those who have the moderate level of investment experience, are more likely to follow or more likely to have social media reliance, because these are the mid-level investors who feel confident to engage with market content, yet they seek validation and external cues from these social media influencer, that whether the decision which they are going to take, whether it is correct or not. So these are the people who are more likely to follow this kind of content, or more likely to act on the advices of the social media. So this behavioral insight which we get from these statistical evidence in our study, that social media amplify herding behavior and social validation. Herding behavior is a theory where basically it is following the trend or follow the people. So when they come across a lot of content about people investing or people promoting certain kind of stocks and shares, so they also feel compelled to follow them or follow their advice. Also, it says that intermediate investors have confidence, and but at the same time they want to get confirmation that whatever they are thinking is correct or not. And most of the time, their decisions might be shaped by overconfidence, availability bias, and prospective. So these are some of the things which we came across during behavioral finance. Then it is digital impact is also there. High exposure to stock related content when increases online reliance, because as you all know, these social media platforms, Instagram, Facebook, and all, they work on certain algorithms, which once you start viewing a certain kind of content, they will give you more content of that type. So as more and more content, as the investors are exposed to more and more content, their online reliance is likely to increase on these kind of mediums. Financial influencer and communities through these mediums are shaping perception of the people. So investors' behavior is not purely rational. Investors do not always behave rationally. They do need to follow the investment advice. So there is need for greater investor awareness, which government is already doing. They are giving that we should not invest based on unsolicited advices from different social media programs, and there is a need for stricter regulation for digital finance content. Then what are the main outcomes which we have come across, or what are our main findings related to implications of these? So for investors, the implications are that before following any kind of information, investors must verify the information which they get from social media, and they should use multiple and reliable information sources. They can read good financial magazines, financial newspapers like Economic Times, and these things. So they should verify the information which they are getting from these social media sources, should be aware about personal biases and herd behavior, and should treat financial influencer advice as a supporting input, not the main basis for their investment. For regulators and platform, there is a need to strengthen the regulation of financial disclosures and financial influencers, which government or SEBI is already trying to do. Clearly flag sponsored content and unverified investment claims should be marked as such, and then integrate investor education and risk warning within social media and trading apps. this is one area where it can be increased. Then for financial institutions and educators, they should share credible evidence because some of them are, I'm not saying all of them are giving the wrong information, but some of them have a huge following and they do give credible evidence based financial information. So they should encourage more and more kind of credible information. There should be a focus on financial literacy program for the young investors basically, and they should educate investors about behavioral bias and risk management, and should give them an idea that they should not solely make their decision based on their information. Rather, investors should be encouraged to make their own decisions, should know how to make investment. So they should also educate them in their platforms. So to summarize the study within 1 minute, I'll just give you a summary. Just examined how social media influence the investor psychology, and we found out that investors are increasingly relying on these social media platforms and financial influencers, where they are likely to invest more or likely to follow them more if continued exposure is given to them. Then we came across behavioral biases such as herding, overconfidence, confirmation bias, and other things in the research. Then social media is a powerful but double-edged force in investment decision making. Many times it is difficult to verify whether the information is correct or not. So this has to be handled very very carefully. With improved information access and participation, it has also increased the risk of behavioral biases among intermediate investors. And many a times it is found that investor decision is not purely rational, rather it is shared by online narratives, peer influence, and influencer-driven content also. So there is a need for greater investment awareness, responsible creation, and regulatory oversight to ensure informed and sustainable participation in the capital market from the investors. So this is all from my side. This is just a brief outline of the paper, keeping the time in the constraint of timing. I'm open for if there is any suggestion. I'll be more than welcoming for that.
So, Dr. Ankit, thank you for a very nice presentation.
Thank you, sir.
The presentation also had recommendations which can be used by the policymakers, so that is a good part. I just wanted to know, like you have mentioned that the sample size is 71.
Yeah, this is there. So it's a very small sample size.
Yeah.
It is difficult to generalize that.
So, how did you choose this respondent? I mean, did you follow any
Sir, basically, the method which we have to follow because of certain limitation was our purposive sampling method, because we came across certain group of investors by our personal knowledge and personal peer groups who we know were investing in the stock market. So we have tried to collect information from our circle of the people who we know were either investing in social market or who follow the social media advices. So the sampling which we have dependent upon is basically purposive sampling. Paper, if you see, we have also mentioned this was one of the limitations, that because of certain reasons we had followed purposive sampling. So the result which is there might not be a correct reflection of the overall picture of the stock market.
Dr.
But based on this study, I would like to, expand upon this, and maybe we can conduct a larger sample and we can conduct a better study for that.
I think that will be a good idea to increase the sample size and also to have some details about the respondents, some descriptive analysis of the respondents. So that will add more authenticity to the study.
Sure.
Dr. Barun, for your inputs.
Yeah, thank you. Ankit, I mean, what I found is an interesting, at least the title, I was excited the moment I saw the psychology of online investing. But if you have to publish it, I found a lot of lacuna in the work. For example, when you have to mention it clearly about your data sets, you use both primary and secondary. So, your from the presentation, I know it's 10-minute time, it's not enough to do that. So that is not clear. Who were the sample? For example, in your statement, you told that was your known circle. So how you remove the bias and all, and that was not mentioned anywhere. So until unless you are not clear about that, publishing will be a difficult, and I'm sure that your target will be to finally publish into the decent journal. Second thing that you talked about some herding behavior, because since you have not presented your results, so I'm not in a position to comment more because I don't find much results in the presentation. So I don't understand how social media influence herding behavior. If you could have been, did you tested it through the causation or through association? I'll be very interesting to know about it.
Sure, sure.
And last question, on this a small sample size, we should usually avoid to giving so many recommendations and all. So, if you want to really give recommendations, at least I'll just request you to have a larger samples. Otherwise, it will be biasness in all the suggesting big things. Okay. So, I want to hear mainly from you on the herding behavior and then how you got on that.
Okay. Thank you for your input, sir. These are some of the shortcomings which I was aware they will be there in the big. First of all, the sample, I know it is very small. Actually, we shared this survey, the questionnaire online through Google Forms, through different WhatsApp groups and different forums. We got somewhere around 100 responses initially. But when we filtered the data, we corrected the data, we come across 7, because many people just left the.
What was the response rate? What is the response rate in terms of percentage?
Sir, we got when we shared this, so we got around 100 to 110 responses.
How many people you share? I'm just.
Sir, because it was shared on various WhatsApp groups.
Okay,
so,
various WhatsApp group. Okay.
Yeah. So I will not be able to pinpoint the exact number.
That's fine. That is quite obvious.
Yeah. Then out of when we filtered the data, so many of the people were not. They have not completed the survey because some of the questions which we have put in the survey, they were not mandatory. So people have left it. So after the filtering, we came across 71 responses which were complete. So we have, first of all, we have taken data from that. Then when we talked about herding behavior, because again, I'll come across, I agree with that. In such a small sample, it is difficult to identify the herding behavior is there. But in our analysis, when we put this correlation and chi-square, we came across that there is a chances that people tend to follow these investors, which they have. We have certain subjective questions also, where people are saying that we might not invest initially in this by the tips of these investors, but the continuous exposure to these tips and continuous exposure to these platforms, we may tend to, or we got influence, and many a time people share this information with their peer group. Like if they come across any tip, they might not invest it themselves, but they will share it with their colleagues and their groups. So this is what we come across our study. I'm sure I was not able to cover it in our presentation to short way, but I have mentioned all these things in the paper.
It's interesting, and then wish you all the best to publish it.
Thank you. Thank you, sir. Sir, may I ask you one question, if it's possible?
Yeah, go ahead.
I just want to ask, what are the things which I can improve upon this so this can become a good paper publisher?
So, do we have time, sir? Can I take 1-2 minutes?
Yes, sir, we can have.
So, Ankit ji, I can tell you my experience. I have a couple of papers in the top journals. Most of the things they will talk about your methodology. Most questions comes from methodology. And then how nicely you interpret the result. Your techniques doesn't matter. No need to do, how complex your technology is, how nicely you're building the story. The better the story, there is a high probability that you will publish the simpler story into the better journal. So when you're talking about, for example, one concept is herding behavior. Now, you make a story like, look how herding behavior is that if one investor is getting in one dimension, everybody who follows will go into that trends. If you can link it with the data sets which you have collected and try to make a story. What we do usually, we are unable to make it a story. So try to make a story, and then if you are going to prove with your data, any journal will be happy to take your paper.
Okay.
And that's
So
what
some
when
kind
we
of
review, we see the same thing. Like, I mean,
sure,
we see sometimes certainly complex
sure.
techniques, but rather than that techniques, I'm into editorial board of couple of journals, the Elsevier and Springer, we see that mostly
Okay.
like what, I mean, kind of story you are going to build. That is more important. But certainly your
So
tools and techniques are important, but that comes secondary.
so some kind of case study or something can be included
That
in
is
this, sir.
fine. That is your, and you just see the objectives of the journal. Does it align with your area and all? Then it'll be fine. Doesn't matter you're doing case or doing a data. Both are fine.
Okay. Thank you so much, sir. Thank you
Good
so
luck.
much.
Can we move to the next paper, please? Yeah. So the next paper presentation is by Dr. Dri Sri Devi, Daripeli Anusha, and the paper title is Financial Sustainability of Ecotourism Projects in Telangana, a secondary data-based evaluation of revenue trends, operational viability, and long-term development needs with respect to tourism financing. So over to you, Anusha. Your audio is mute. Yes, yes, you can now speak. Can you share your slides, please, first?
Hello,
Yes, please share your slides, please.
one second. Is my slide visible?
Yes, your screen is visible. Kindly go to open your PPTs.
One second. One second.
If it's not possible from your side, we have your PPT. Can you present from our side?
I am trying, but it is not happening.
Okay. So please stop sharing your screen. We will share the PPT from our side only.
Okay.
Okay.
One second. I tried, but then it is not happening.
Is the slide is visible to you, Anusha?
Now it's
Yes.
visible. Yeah.
Yes, yes, yes. Am I audible clearly?
Yes, you are audible.
Okay. Shall I start?
Yeah, please
Yes.
start.
Good afternoon, sir. This is Anusha from Apollo Institute of Hospital Administration. Me and my professor, Dr. Sri Devi, both of us has done a. Am I audible?
Yes, you are audible. Please proceed.
Okay. We both did this research track on financial stability of ecotourism projects in Telangana. It is a secondary database. It is secondary database which says revenue trends, operational visibility, and long-term development in the respect of financial tourisms. Next slide. So we did this project totally based on secondary data. This research track says about tourism's major which contributes of economic development, employment generation, and infrastructure growth. This is ecotourism focuses on natural based tourisms, environmental conversions, and community participation. Financial sustainability has been a crucial due to high investment, maintenance, and conversion cost. And also, ecotourism projects often develop on government funding other than private funding, and it has a lot of revenue when there is a seasonal tourism when there is a season. And also, this project has done in Telangana. As I said, Telangana has emerged as an important ecotourism destination with sites like Anantagiri Hills, Laknavaram Lake, and Kavala Tiger Reservoir and Bogota waterfalls. These are one of the most emerging ecotourisms in Telangana. And also, this tourisms are supported by Telangana government only. And also, I did this project on the based in the basis of 2019 to 2024. It is a secondary data, as I said. Next slide. And the objectives are we mainly examined the financial stability of selection of ecotourism projects in Telangana using secondary data, and also we did an analysis of ecotourism destinations during a period of 2019 to 24, and we identify key financial challenges for a long-term sustainability of ecotourism projects, and also we did suggestions and the measure of improvements tourism financing and enhancing financial sustainability in this track. And also the research methodology for this track is we did a descriptive research design to access the financial stability of ecotourism projects. This is a secondary data. And also the sources of data are by annual reports of Telangana tourism, and also government budget reports, and also policy documents, academic journals, and credible online resources. And we study period of this research track is 2019 to 2024, which includes pre-COVID, post-COVID, and also post-pandemic recovery. And also study areas are we focused mostly on Anantagiri Hills, Laknavaram Lake, Kavla Tiger Reserve, and Bogota waterfalls. And the tools we used here is descriptive and comparative analysis between the four destinations. And also the scope and limitations are limited. There is a lot of financial limitations because it is a secondary data. No primary surveys or interviews are done, and also data availability varies across destinations. And also after our study on the research track with the secondary data, we analyze that this study mainly focuses on revenue trends, operational cost, investment patterns, operational viability, a comparative assessment of selection ecotourism destinations. So revenue trend for among four are for Laknavaram Lake. Laknavaram Lake takes a lot of highest revenue among the selected destinations. Multiple paid activities because Laknavaram Lake has a lot of activities like boating, rope bridges, and accommodation. Stable tourism inflows during the peak seasons. Anantagiri, when it comes to Anantagiri, there is a steady of revenue growth. Advantage of proximity in Hyderabad because it is very near to Hyderabad. There is a lot of rush of tourism in Anantagiri Hills, and it is a moderate revenue due to limited paid services. It is not a lot of paid. There are very less number of paid services in Anantagiri Hills, so it is a steady revenue growth. And coming to Bogota waterfalls, it is a low revenue despite of raising tourism numbers, and also limited infrastructure, and also there are limited paid activities because it is a waterfall. And Kavala Tiger Reservoir is a low revenue low revenue thing, and also the tourism is restricted due to the conversions prioritized, because it is in Telangana. Kavla reservoir is under in a very it it comes in a very localized place, wherein tourism does not attract a lot, but it is also one of the most on telling designations of Telangana, and it earns a lowest revenue. And also the operational cost and investments of this our project is Laknavaram and Anantagiri are moderately operational cost. Revenue aligns with expenditures. Bogota waterfalls are highly expensive and safely cost, and revenue recovers remains low. Kavla Tiger Reserve is higher conservation and operational cost, highly depends on government funding. Among these, lot of these are depends upon the government funding only. Coming to financial sustainability, these designations with diversified revenue sources shows better sustainability. Laknavaram is one of the most financial stable spot, and also Laknavaram shows a moderate sustainability. Bogota waterfall shows a moderate, and Kevala shows a weakest due to the conservation focus. Overall findings from our research is strong dependence on public financial across the economic tourism projects, wherein it depends upon the footfall of the place, and also needs to improve tourism financial strategies by giving play areas, and also revenue related revenue. There should be a strategy planning, and coming to financial planning must be done integrated with the conversation goals. And from this, our key findings are ecotourism destinations with diversified tourism activity shows a better financial sustainability, like Laknavaram and Anantagiri Hills. For Laknavaram Lake, the stronger financial program due to multiple revenue sources such as boating, rope bridge, and accommodations. Anantagiri is a steady financial because it has lot of inflow, diversification, and restricted area revenue through limited services. Bogota waterfalls is a moderate financial results, growing which is a growing tourism, and also not matches by a revenue due to its inadequate infrastructure and paid activities. Kevla Tiger Reserve is a because that is the weakest financial performance due to its high conservation cost and restricted tourism activities. Most eco-tourism projects in Telangana remains highly dependent on government funding, and also these tourism revenue along with is insufficient to meet its operational and development expenses. There is a strong need of diversification revenue models and improve tourism financial strategies. And to conclude with, I after our research and all, we after our research from 2019 to 2024 data, which is secondary data. Financial performances vary significance due to its difference in revenue generation, operational cost, and conservation requirement. Laknavaram and Anantagiri emerged a lot of financial stability designations. Bogota waterfalls and Kevala as a weaker financial performance due to its lowest limited revenue activities and high maintenance on a conservation cost. And also ecotourism projects remains highly dependent on government funding, and also revenue along its often too insufficient to meet its operational expenses also. And effective tourism financing strategies should be done to balance its environmental conversions. And also financial planning and improvement revenue models are essential to sustainable and ecotourism development in Telangana. There should be a structured financial planning to emerge the areas. And our suggestions are diversification of revenue sources, introducing an additional paid activity such as guide tours, eco-friendly adventure activities, and accommodation facilities, strengthening public-private partnership, collaborating with private stakeholders for infrastructure development and service improvements, improve financial planning by specific financial strategies aligning with revenue potentials and conversation goals. And also, our suggestion is infrastructure and facility development, spending on visitor amenities, safety measures, and accessibility, especially on emerging destinations like Bogota waterfalls, balancing conversions and tourism promotions, promoting areas like Kevala and Bogota will generate more revenue in future. And also digital promotion and pricing strategies, using digital marketing and advertising them might also help in revenue to attract tourism and enhance revenue sustainability. These are some references we took for our project.